All right, guys. So thanks so much for everyone coming on to the mastermind this month. I know I was a few weeks behind on this one, but I've got an awesome guest on our mastermind tonight. It's a guy named Mike Schwally. He has been a huge impact. He's had a huge impact on me and my understanding of this strategy. He's actually the one that got me involved in infinite banking, and he stuck with me. I'll tell that story in a minute, but of course, just kind of the itinerary. Let me jump in really quickly on back to the basics. If you guys remember what we're doing basically just going over why we do infinite banking first. Well, I'm going to lead it over to Mike. He's going to kind of tell his story about how he was a business owner, sold that business, got into infinite banking. And then, of course, we'll open it up for some questions at the end. I've even received some questions from some other guys in the past. So let's just jump into this really quickly. So here we go. Let's see here. Okay. So again, guys, view here. Let's see here. So our slideshow, I'm not going to bore everybody with the slideshow, but again, this is just part 3 of our entire strategy on how to eliminate income taxes. And how you do this essentially is through bonus depreciation with commercial real estate. And if you inject equity from life insurance, your money keeps growing tax-free, of course, uninterrupted, as we know. So again, guys, before we jump into anything else, again, back to the basics. We finance everything that we do, right? We're either borrowing from somebody else. This is the Nelson Nash way, of course, but we're borrowing money from somebody else and we're paying them back with interest, or we're saving up cash and then we spend our cash and we give up the ability to earn interest. So what happens is, of course, we don't really get anywhere with either way, whether we're borrowing someone else's money and again, we pay them interest, or we spend cash and we give up the ability to earn interest. So it's either one or the other. There's no really in between until, of course, we discover door number 3. But of course, infinite banking, what happens is when we make deposits into these life insurance policies that are structured for cash or uniquely or specifically designed for cash value, we never are interrupting the compound interest of our account. So every time we make deposits, it just continues to grow that principal amount each and every deposit, whether it's a monthly or whether it's an annual deposit. Those dollars continue to stack on top of each other. And then we have the ability to borrow against that principal or that cash value that we've accumulated and deploy it into investments or business equity or real estate that we know better than anything else. So again, life insurance is not an investment. It's just a better savings warehouse or a better location to warehouse our cash before we know the investment that we want to deploy our capital into. Okay.
And Nolan, I'll interrupt you on that.
Go back of course.
Real quick. You know, the key there is below the line, someone else is in control. You know,
That's right.
Above the line, we're in control. You know, we want to be above the line. We get that. We all want to be above the line when it comes to cash. Now with infinite banking, we get the ability to control the leverage that the banks used to control against us when we borrowed money. Now we're in control of the capital. The capital continues to grow and we get to control and do different things with our money, with the cash flow. So sorry, just wanted to add that.
No, man, no, 100%. And more importantly than anything else, of course, with all the, this is being recorded in May of 2023, but with all the noise going on in the world about banks being gobbled up by bigger banks and there being runs on banks, as Mike knows, and all of us in the mutual insurance world, there's never been a run on a mutual insurance company. So for every dollar, just to do a quick history lesson, for every dollar that is out deployed in the marketplace that the banks are lending out, let's say you have $1 in a deposit, there's only, for the most part, fractional reserve lending, there's about 10 cents inside of the reserves for these banks. So anytime that there's, more than one person or even 3 people that want to go to the bank at once and get their money, the banks have to sell their bonds in order to create a liquidity event. But because all these bonds that they purchased in the past, 36 months, 48 months ago, they're actually having all these bonds at now a loss. Now they're taking 30, 40% losses on their bonds that they purchased in the past in order to have a liquidity event for all of their depositors trying to withdraw cash. So they're in a really tight pinch. Well, with mutual insurance companies, for every dollar that is on deposit, I'm not going to speak for one particular mutual company, but for every dollar that's on deposit, you have over $1, most sometimes even higher, $1.25 of reserves. versus in banks, it's $1 that you have in cash. It's a penny in reserves. You've got $1.25 in reserves with mutual insurance. So just to do a quick little, I don't know, history lessons of economics. But again, why are we doing infinite banking? I want to just dive into this really quickly, and then we'll turn it over to Mike because he's got a really good story. But again, there's only 3 locations where we can locate capital, that we can house capital. It's tax today accounts, your bank account, things like I just mentioned, where it's not as safe as what everybody says it is. You've got tax deferred, your 401ks, your IRAs, and then tax never, your mattress, your safe, in infinite banking. Going into all of these really quickly, I'm not going to dive into too deep, but if we go down the tax today column, we're not getting a competitive rate of return. Of course, we have liquidity. I wouldn't call it safe because unless you have more than the FDIC. But believe it or not, it's not tax-free if you're earning anything. I think there's the Apple savings account right now that's out there throwing off 5%. Well, of course, you got a Tango with Uncle Sam. He's going to get a slice of that. It's not creditor protected. If you're ever being sued, nobody's ever going to be able to, no lawyer is going to say, oh, I'm not going after his bank account. That's the first place they're going, is your bank account. And then, of course, whenever you've got money that, you want to go buy a car, you want to go, buy a new pair of shoes, and you take money from your account, it's no longer earning for you. Let's go to tax deferred account. Competitive rate of return in our 401k or IRA. That's what we're comparing this to right now, which is an investment, by the way. Is it competitive? We hope it's competitive, or it wouldn't be there. It's not safe because, as we have seen in the last 12 months, it's gone down. It's not liquid. We got to keep our cash in there till 59.5. It's not tax-free. It's tax deferred. It's creditor protected, thankfully. Now that's up to, depending upon what state that you're in. But then, of course, it's not uninterrupted. Whenever you go and start taking cash out to go do something with it, you're no longer earning on those dollars anymore. So let's go to infinite banking. Is it competitive? Of course it's competitive. We're earning 4% guaranteed in these contracts. Plus, we're going to earn a dividend. I like to be conservative and say 4.5%. Now, again, that's different on whatever insurance company that you work with, but let's just call it 4.5%. It's safe. You cannot lose money. Every single day of the week, you're earning more than you would. You can never go backward in these things. I actually had a mentor of mine. He said, imagine you're playing baseball, and you've got, if you're in private equity, you might be hitting home runs. Well, life insurance, you don't maybe hit home runs in regards to returns, but you're always hitting stand-up doubles. You're always on base, and you're always moving forward. You're never going from second to first base. You're always going from first to second in regards to growth. You can't go backward in these. It's liquid. It's the same liquidity as where, hey, Nolan, I need a policy loan. I say, sounds good. Grant, it'll hit your account in 2 to 3 business days. It's a text message. It's tax-free. All the growth inside of these things are never touched by Uncle Sam. It's creditor protected. I even like to go a little further and say it's completely private. Nobody knows that you have money in these things, especially if you ever have an attorney trying to get after you. He unless he sends you a subpoena, he can never know actually what's in these things. But then really what the straw that stirs the drink is when you got money in these things, you never interrupt the growth. You're always essentially taking they're going to put a lien on your death benefit. So imagine if you've got 100,000 in cash value, you've got $1 million in death benefit. You go take a $60,000 policy loan to go purchase a piece of real estate or whatever it is. You're still earning on the $100,000 inside of your cash value. That's not being interrupted because you're not actually removing your money. You're actually using the insurance company's money. And we can go into some more leverage. I know Mike will get into that in a minute. But most importantly, your dollar continues to grow as if it never left, and you're earning on that principal amount that you deposited. So you ask people, would you rather earn on a small number or a large number? That's kind of what infinite banking really comes to be. So I won't get into the design, get into a little bit of how the policy is broken down. If we all remember, basically $100,000, you've got what is known as the flexible paid up rider. It's essentially our fancy word for cash value, but what it does essentially is purchase more death benefit for no cost, and all the money goes to cash value. And then the base premium is, in the very first year, it's illiquid. It's Uncle Sam. It's the IRS basically drawing the line in the sand, saying what we can and can't do. We got to send a little bit of money to expense, just because if it wasn't, it would be a modified endowment contract. And that just means that you're going to get a 1099 every year for all the growth that you earn in your policy. But it's flexible. I won't get into all this because we know this, but I really want to dive in really quickly, and then I'll turn it to Mike. How we compare infinite banking to a home equity line of credit. So if we're looking on this left-hand column here, let's look at a real estate property or a piece of real estate. Let's say that you make a deposit or you make a down payment on your property of $100,000. It's $1 million home. Well, most people can either, if they want to go redo their kitchen or bathroom, you can take a second mortgage, you can borrow from your rich uncle, or you can borrow from your home equity line of credit or your HELOC. And so what that does, though, is every month that you make your mortgage payments, you're building more equity in your home. And so when you want to borrow from your home equity line of credit, they're actually not doing anything about your equity. What they're doing is just going to slap a lien on your asset or the home. Because when you borrow against your HELOC, the bank doesn't really look at so much as the equity in the home. They look at the asset that they're lending against. It's the same thing with life insurance. When you make a deposit or this equity or this cash value that you have in your policy, you go and purchase death benefit. That's the asset in the insurance company's eyes. So when you want to go and borrow from the equity, because again, a premium deposit is identical to a mortgage payment. You're building equity. When you go and borrow from the equity or the cash value in your policy, they don't remove the equity or the cash from your account. They slap a lien on the asset, which is the death benefit. And so your money continues to grow and compound and earn as if it never left, because it hasn't left. They're just letting you get a prepayment of death benefit of this huge asset that you purchased with that illiquidity in year one. So that's kind of where that's at. So Mike, I want to turn this over to you as you're kind of our guru when it comes to, you're the one that brought me into this game, man. And I want you to kind of tell your story. So let me make you the host. There you go.
And while you're doing that, man, I want to add that last piece that Nolan just pointed out. The equity in your home that you build up when you borrow against it in a HELOC, it doesn't lower the value of your home. The value of your home is still right. $400,000, $1 million, whatever it is. Just because you borrowed against it doesn't lower the value. Same thing works in that life insurance contract. When you borrow against it, it doesn't lower your cash value. The value is still there. So great point, Nolan. Good stuff right there, guys. Hopefully that made a lot of sense to you. All right, I'm going to share two different examples. I'm going to start with this one because this is where I started. And, Nolan talked about me being a business owner, and I could share a real life example. You see my screen okay? Just want to make sure.
Yep, you're good to go.
Okay, good deal. So, I business-wise, we did use this strategy. We used it right away. I had a buy-sell agreement. We had term insurance. We used some cash value from we use cash all the time. We were big Dave Ramsey guys at our office, and but we had a line of credit open at the bank. But that's a great solution. I can go into that. But what really hit home with me, and this is what I'm going to share with you guys today, is the advisor in this office that taught me this about 15 years ago sat me down and said, let's look at your personal finances. What are you doing personally that maybe we can enhance and do a little differently? So this part of the book, the Becoming Your Own Banker book, really stood out to me. You finance everything you buy, you pay interest to someone else, you give up the ability to earn interest. And it took me a while to understand that because that's not what Dave taught me, and so it took me a while to understand that. But when he broke it down and he showed me the numbers, here's what he showed me. So he made me bring in 5 years of my savings account statement, my wife and I's security fund, our emergency fund, right? And in 2006, we had about $36,000 in our account. That was our, savings. We didn't want to go below that line. We wanted to kind of stay in that world. So this is very similar to what Nolan just showed you. But, here's real life. This is what we found out. So I was saving about $600 a month. So about $7,200 a year, we were saving into our savings account on average. And so we would build it up. And then life happened. We needed a new deck on our house. We put about a $6,000 deck on our house and we built it up, paid cash for it, right? Well, we went below the line, we refilled it. Then my kids needed braces, right? Had to go back below the line, had to refill it. Then we decided, then our air conditioner went out. It was a pretty expensive air conditioner at the time, but about $6,000. That was, back in the Obama days, and they actually gave us a credit because it was a real high efficient air conditioning unit, but real life situation. And
The
then we went
Obama
on
days.
vacation. Yeah. Hey, you got to take care of those credits when you can get them. Then we went on a vacation with the family. You know, we spent cash. And then my wife, this was a big one, right? About a $20,000 hit. My wife wanted the new SUV. We bought that. That thing lasted for about 12 years. Just got rid of that a couple of years ago. But all the different things. So, you know, we went on another vacation. We went, you know, kitchen renovation, like Nolan mentioned. I bought a used truck, didn't spend much money on that. You know, the wife got the new car. I got the used one. You know, a Disney trip, and then, you know, a couple of different things that we did. But basically what I want to show you is we started with around 36 and we ended with about 36, right? This was real life for us. Well, during that time frame, there was about, I can't remember the number, but I think it's around $70,000 that we spent during that time frame. You know, money going in, money going out, money going in, money going out. This is real life. And so he sat me down and he said, look, what if we could do this with infinite banking? You don't change anything you do cash flow wise. You don't take any risk. You don't work any harder. And we just do it through a more efficient vehicle. And he showed me that my balance, my balance would have grown to about $75,000. So same cash flow, same everything, and having about $40,000 different at the end of that time period. So that's opportunity cost. That's the money that I interrupted every time I spent my cash. It went down and I had to refill the bucket, right? And so that opportunity cost adds up. And then that was a big deal for a 5-year time period. But then he showed me a lifetime. You know, he showed me a 35-year time period. Well, that 35-year time period added up to $804,000. That means I don't change anything I'm doing. I still save the same amount of money. I still buy the same amount of stuff through my lifetime. But at the end, I've got $804,000. I empty and refill, empty and refill. It's a long play, right? And Nolan will tell you, this isn't a get rich quick scheme. This is a get rich slow scheme. That's tax-free $800,000. That's 1.5 million in a qualified plan, basically. Who knows what taxes are going to be in 2045, right? So that's the difference. That's not bad for a savings account, right?
Mike, can you go in really quickly?
Yeah.
I want you to talk about what opportunity cost. What is that? Where is that money? What happened to that? Like where is that going? Who earns that?
That's a great question. I would challenge everybody on this call. You know, who is earning that money if it's not me? Anybody got something? Well, what does the bank do with your money?
Your bank.
Thank you. There you go. Great job. Grant gets the 10 extra bonus points today.
There we go.
But so the bank is earning on that dollar. When you make deposits, they don't put that money in their safe and earn, you know, let it collect dust. They are going out and deploying that money and making money with your money. Same thing works here. We are becoming the bank. We are taking ownership of our cash flows, of our collateral. So when we do that, now we earn just as the banks would over our time period for all the purchases we're going to have in life. Trust me, it hasn't stopped. We're in 2023. I'm in the 14th year of this policy. And here's this exact policy. This is my policy. This is the one I started 14 years ago. I am right here in that policy year. All right. There's a couple things I want to point out. You know, it's compounding. I made a $7,200 deposit this year. What did my cash value grow that year? 14K.
You almost doubled your money, Mike.
Say it again.
I said you almost doubled your money.
I did. Yeah, almost doubled that year. You think I can't wait to make this deposit next year? You're dang right I can't, because next year it gets better. The next year it gets better. The next year it gets better. You know, by year 30 down here, I'm making 7,200 and it's going up almost, you know, 32K. It's more than tripling. You know, that's a generating, producing thing for me. And I'm going to keep funding it forever. But that's that $804,000 in 35 years that I'm going to have, you know, whether I retire or not. I don't plan to retire, but I'm going to keep on doing this. And this is just one of my policies. I have 6 of these, you know, so I've got 2 on me, 2 on my wife, and 2 on my kids. And this is how we're going to have a family banking system. Everything we do in life, mortgages, cars, go on vacations, it's going to come through this vehicle. So this is just one of the pieces. So I'm gonna stop this one and quit talking about myself for a second, and I'm gonna share another one here. And let me see here. Ooh. All right. So I want to show you guys another solution because this is a real life example of a student that we worked with.
This is awesome, guys. Check this out. This is great.
So this is a student that we were talking to, getting out of college. She was a medical student. She had about $205,000 worth of student debt. And the first thing she was going to do, because that's what this is what her dad told her to do, is the minimum payment was going to be about $500 a month. And she knew that she could keep kicking the can down the road like all the other people that are in the student loan debt world right now, but she wanted to get out of debt. And so she was going to pay $2,000 a month instead of $500. Her minimum was $500. She was going to throw $2,000 a month because she's making $400,000 or $500,000 a year. And she was going to throw $2,000 a month at this student loan. And luckily we ran into her and we showed her another strategy. So this is a debt reduction software that we use called Zilch. And it showed her that starting with that almost $205,000 worth of debt, it was going to take her roughly about 8 years and a couple months to pay that thing off. So what you see up here is the extra $1,500 of pledge money she's putting in. She had to put in $500, but the extra $1,500 got her to reduce her debt just by throwing cash at the solution, right? So we stopped her and we said, hey, what if there's a better way? What if we could show you that $1,500 a month, still keep on paying your $500 minimum, but that $1,500 a month, what if we save that up? Well, let's compare it. Forget she ever met us and forget infinite banking. What if we just put that money into a shoebox? Well, that shoebox is going to earn nothing, and it's going to be $144,000 over an 8-year period, right? Well, if she put it into a money market or a savings account, let's say that money market or savings account is earning 1.5%. Remember, this is 2018. Rates were a little different back then. But if she would have earned that $144,000 would have grown over her lifetime to $229,000, right? So, and that's only contributing for 8 years and then stopping, never putting another dime in. Well, the solution was, what if we took a loan from that savings account or that money market and paid off that student loan, right? Instead of putting money and giving it to the student loan, put it in the savings account in our money market, and we take the money out because we've been chipping away at $500 a month. And by the time 8 years came around, there was about $140,000 left over that she had to just write a check to the student loan creditors, and we paid them off, right? She's done. Well, she never put any more money in, and that account's only got $14,000 when she's, down the road about 70 years. Well, she freed up cash flow, right? She freed up a couple $1,000s a month. So a good person would put that money back into that savings account, refill her bucket, right? So if she took that 140 out, if we said 5 years, it took her $28,000 to a little over $2,000 a month to pay that back. She'd refill her bucket and she would get back to that 220 mark that she had a few years earlier, right? There's nothing wrong with that. That's what most people do. They take a loan, they pay it back, and they get back to even.
That's what you were just describing, Mike. You just showed that whole song and dance over the last, over your years before. That's exactly what you did. And that's exactly what everybody does. Yeah.
And that's what most medical students, when they get out of debt, they're trying to pay down with cash, and then they refill their bucket, right? So that's the average America is what we're looking at right here. Well, we showed her, what if we did the same thing, but we did it with infinite banking? It's a $900,000 difference over her lifetime. We're going to do the same thing. We're going to put the money, same $1,800 or $1,500 a month, $18,000 a year for 8 years. We take the same loan. She refills it the same way with a little bit of interest back to herself that we're paying back the policy. And look at the growth over her lifetime, tax-free growth. That's just because we thought differently. We acted differently. We took a little bit of risk using a life insurance product as our savings vehicle, but we never interrupted compounding because she had, $150,000 head start on compounding. That's the difference. I'll go back. You know, when you interrupt compounding, this is what happens. You stop the compounding process. But when she didn't interrupt compounding, it just kept on going for the rest of her life. And she's going to get to a 48 years down the road when she's about 65. She's got a $1.1 million in there tax-free. I mean, which solution works better for you? All right.
Yeah, it's a no-brainer. And Mike, would you mind kind of diving in really quickly? We talk about it on the podcast and stuff, but I want you to talk about EVA. You don't really talk about it here. You just said, a little bit of interest. Can you kind of give a 30,000 foot overview on like what EVA is, what is economic value add, and why that is like so important when practicing infinite banking?
That's great. Yeah. In EVA, I'm going to steal it because it was written in a book. There was a large CPA firm that worked for Coca-Cola. And they got called into the CEOs and CFOs and of Coca-Cola, and they sat down, they looked at their books, and they did a deep dive, and they said, guys, you guys are a major corporation. You've got millions of dollars of capital, probably billions. And what we noticed is that when you borrow, let's say Coca-Cola was building a factory in Ohio, and they borrowed $100 million to build this factory. They would borrow money from the bank, and the bank would charge them interest 6-7%, whatever it was. And they were paying them interest to pay off that factory, right? Well, at the same time, once they get that factory in place and it gets built, they had to build their trucks, their fleet or their warehouse or different equipment, whatever they bought, and they were using their own capital and they were using cash. And they noticed that when they spent cash, they were just replenishing that cash with the same, they'd take $1 million out to buy a bunch of trucks. They'd put the $1 million back in over time. Well, so they were practicing, they weren't practicing and being good stewards to their money. They liked the bank's money more than they liked their own capital. So what this company, the CPA firm showed them was treat your money, your capital, the same way you treat the bank's money. If you're going to treat their money with interest, treat your money with interest, treat it with economic value added, give it whatever the economy is going to charge at the current rate, treat your money with the same value as you would. And they're instantly, you can go back and read books on it and look at Coca-Cola's value. Coca-Cola went through the roof. Their stock started going up. Everything started going up because their profits went up because they started treating their money with the same value. So now to real life insurance contracts work the same way. They make us practice. They force us to practice EVA with our dollar. When we take money out of the account, they charge us an interest rate. Now, this one was, I think, 5%. This was done in 2018. The contracts back in 2018 were a 5% interest. The ones today that Nolan and I provide to our clients are 4% fixed interest. So even better, but they force us to pay that back to ourselves. They make us put the money back into our contracts, and they're taking a piece of that. There's profit for the insurance company, but that's okay because it's a mutual owned insurance company and we get to partake in those profits, which in turn gives us higher dividends and higher returns. So EVA is all it is just treating your money with the same respect as lenders or anybody out there that's you're borrowing money from.
I love it, dude. And that's awesome. And so I wanted to do really quickly. I wanted to, Mike, if you don't mind making me the host one more time here.
Yep.
I want to show, let's see here. It's going to let me do it. Oop, hang on.
I got you. Hold on.
I want to show you guys kind of, I did a video on this, and the question that I kind of posed was, does leverage work? Right? Does using other people's money make mathematical sense? And so I want to walk through this because this is something that in my opinion, I think is most people, again, kind of the Dave Ramsey's, they say, well, why would I use other people's money when I can use cash, yada, yada. Now, this isn't very pretty, but I just want to go over these numbers really quickly. So let's just look at scenario one. Does using other people's money or, does using leverage make mathematical sense? Okay. Let's just walk through this. Let's just use this as a real estate deal for a second. Okay. let's say that we're buying, and we can add a zero, we can take off a zero in regards to the purchase price. That's not really important. It's the ratio and the math. Okay. So if we're looking at a purchase price of $1 million, you can inject equity. You can either syndicate it, you can win the lottery and deploy $1 million, whatever. But let's just say the property cash flows $100,000 a year. So a return on investment is essentially your net operating income, and you divide it by your equity. That's how you find your rate of return, right? So 10% here. So what we did is we just divided our cash flow divided by our equity. That provided a 10% return. That's one scenario. That's one way of doing a real estate transaction. And this is just going along with what Mike was just talking about, practicing EVA, but most important, why using life insurance is better. But let's just look at scenario 2. The same thing, a purchase price of $1 million, but instead of you bringing $1 million of equity, you're borrowing $800,000 from a bank, which means that you still have to find $200,000 of equity to deploy. The cash flow is still the same. The debt service is $60,000. Now, again, I know where interest rates are. Let's just kind of use this round number of $60,000, which means our net operating income is now only $40,000. It's a lot less than $100,000 in cash flow, but we had to only bring $200,000 in equity. So if we divide our net operating income by our equity, we have a 20% return versus a 10%. So we can see we're kind of stepping up here. It's showing that using someone else's money or using debt is making more mathematical sense for us to get a higher rate of return on our cash. Okay. Let's look at scenario 3. Same deal, same purchase price. We're going to borrow the same amount of money from Community First Bank or whoever the local bank is. Instead of us using money from a bank account or a checking account or some type of money market, we're going to borrow $200,000 from our policy. We're going to take a policy loan. Now, again, it's kind of like what Mike was saying earlier. Like, why are we paying interest on money why would we pay interest on our own money? It's ours. No, it's not. We're using the insurance companies. That's what allows our money to continue to compound and grow. So if you look, the cash flow is still the same. The debt service is still the same. The cost of capital, which again, I wouldn't even call this like, any equity injection, but just for the sake of math, $200,000 at 4% is $8,000. So let's just knock off another $8,000 of our $40,000 of net operating income to give us $32,000. So now what are we going to do? We're going to divide our net operating income by our cost of capital. It's going to be 400% return on that same deal, the same deal. Now, again, I would even call it infinite because we actually didn't deploy any of our own capital. But if we want to just talk about the cost of capital, you're talking about the same exact transaction from scenario 1 to scenario 3. But the only difference is how we are deploying the equity. So for you investors that are out there, again, you guys, I know that you guys are listening to this. I want you guys to understand how important it is to use other people's money. Now, again, the biggest kicker is most people would say, I hate being owing somebody else, or most importantly, I hate being on the hook for somebody else, where the bank, makes you sign personal guarantees and they make sure that, you sign over the leases and all that kind of stuff. At least with Infinite Banking, there's none of that. Mike would tell you, again, if you want to borrow money from your policy, you just send a text. I don't know a bank that's out there that's saying, hey, shoot us a text and we'll just send you some money, unless you're, a big league guy, I guess. Hopefully we all are, but
unless your name's Nolan Sanburn.
Yeah, right. One day, I guess, for all of us. But hey, I just want to,
and I'll interrupt one more time. I mean, those numbers are accurate, and I totally agree. But let me ask you personally, because you do a lot of real estate deals.
Yeah.
When you get cash flow in from your properties, not only are you servicing your debt with the banks, are you not only servicing every month your debt to the policy?
That's right. That's right.
So that 4% is not actually a true 4%, because these are the type of loans that are daily average balance loans. Every time you send capital back to your policy, they recalculate that loan. That 4% is only accurate if you never paid back your policy for the entire first year. Yeah. So it's even better than that, guys.
Yeah, no, Mike's right. It was one of those things where I was more just going for the simplicity. But again,
I understand.
But the devils are in the details, of course. But most importantly, the way that I look at this, though, guys, is just the fact that, like, if we're going to be doing transactions, if we are going to be transacting business, it just mathematically makes more sense to use someone else's money than our own money. There's no other way to distill it down. If we're going to be doing any type of deal, whether it's from a bank, whether it's from a private money guy, whether it's a hard money guy, whatever it is, whether it's real estate, whether it's business equity, whatever, do not use your own money. Use other people's money. And when I say other people's money, I'm talking about the insurance company's money. So that's kind of my little, my final, thing that I want to say is just don't use your own money. Use other people's money, because it will just increase, it will ratchet up your returns a whole lot faster than it would have if you're just using equity, which at the end of the day, if you got a bunch of money, then that's a great thing. But at the end of the day, though, you got to be using other people's money. Even Aaron Rodgers, who's got a $40 million contract with now I guess the Jets, he literally is still borrowing money to pay to buy a house. Because he understands, hey, it's better to borrow other people's money than use cash. So
Elon Musk didn't use his own cash to buy Twitter.
I mean, seriously, he's borrowing money. Yep. Okay, guys. So look, that was, I hope that was at least educational. Again, Mike, obviously love having you on. If you want to stick around for just a few minutes, just for a couple questions, I know we got quite a few guys on. I just wanted to hear if you guys, everybody that's on here, if you want to unmute and you want to ask a question, if you want to talk, have a thought or idea, or maybe Mike can answer for you. You got it, the stage is yours.
Michael, I'll go. I think one of the things that Nolan and I talked about is when you get to a certain point within your policy that you've kind of tapped it out, leveraged it. At what point did you see there was the need for the next policy? And
great question.
That's one of the things that I've got swirling in my head quite a bit.
No, it's a great question. There's two answers to that. The first one was, number one, my income raised. I started saving more money than that $600 a month, and I had kind of maxed out the rider. So that rider only lasts for about 4 to 6 years. So You're not going to put that rider in any more than about 4 to 6 years in the first beginning of the policy. So I got two things happen. Number one, I wanted to start one on my wife. Our original policy was kind of just for our savings, and we used that. But that second policy, I started noticing that, hey, every year I'm writing a pretty good sized tax bill, and I wanted to start running some of that money through my policy. So I started one on my wife. Purely, originally, it was just set up for taxes. So we started the second policy on my wife because I didn't need more insurance. I needed more places to park capital. So I started the second one on my wife. Then the next thing happened was I couldn't put any more rider into my original policy. My original policy rider was about $17,000, $18,000, and my base premium was at 72 that you saw. And so all I could put in was that 7,200, and I had nowhere to put that extra 12. And I had a little more income at the time. So I said, hey, now's the perfect time. I'm going to start a second policy. And what I had was some extra term insurance. I had a large amount of term insurance when I first started because I was young. I was a lot healthier than I am now. and I bought a ton of term insurance. So if anybody on this call is listening, buy as much term insurance as the insurance company will possibly allow you early on when you're young, because all that is a placeholder. So when life does happen and you earn more income or want to start a second policy, you take a piece of that term insurance, convert it into another policy. I didn't have to go through any medical exam. I didn't have to prove anything. I could have had skin cancer. I could have had something could have happened to me. I wouldn't have had to show anything, just some signing of some documents. And I got a second policy started on me. And I just started funding that one, so. And hey, there's crazy things that happen in this world. COVID happened, different things happen. Life throws curveballs sometimes, and capital gets dried up. Hey, but I had a home equity line of credit. I used it one year to fund my policy, just to keep the thing going because I was low on capital one year. So I borrowed from my home equity, paid my premium, paid back my home equity, and I fulfilled my obligation for the policy that year. You can get so creative with these things. Everybody worries about oh, it's a long-term play that I gotta fund for the rest of my life. No, it's not. It's just capital that we put in. The obligation from the IRS is 7 years. We got to fund these things for 7 years. But as you saw, I'm in year 14. I can't wait to fund my policy next year. I can't wait for that. And mine comes in December every year. Merry Christmas. You know, every year I get to drop in $7,500 and it turns into 15. I mean, that's a great time of year for me. So yeah, that's it. Hopefully that answered your question.
Yep, sure did. Thank you.
And Mike, can you kind of go in a little bit, because we haven't really discussed this, but I know there's some guys on the call that, you know, may have some children and things like that. Can you go into maybe what it's like for, you know, when you, I mean, we're putting a policy on my 9-month-old kid. So what is it like for you, like in regards to kids? Is that a move? Is that strategy? Like, what's on your mind regarding that?
I mean, first off, I'm so jealous of my 2 girls, you know, like, I mean, we got started for my oldest and my youngest about 7 years ago, and they weren't big. I mean, we did about 250 a month in my one child and 200 into my other child a year, you know, couple $3,000 and $2,400 a year into a couple policies. Right. But they were in their, you know, 7 to 8 years old when we started. And, well, no, they were a little bit old, 11 years old and probably 7 years old. So my oldest now just went to college, right? And I'll give you a real life scenario to answer your question. We funded her policy, funded her deal was, you get a college scholarship, I'll buy you a new car. And so I own and I control those policies, right? That's my money, even though it's on her life. And I'm the beneficiary, but I'm the payor and I'm the owner of the policy. All she is the insured. So when she got that college scholarship, she's playing basketball in college, very proud of her. I owed her a car. So I took a $20,000 policy loan from her policy to go buy her a car. She doesn't know this, but to go buy her a car. Now I'll refill that policy, you know, and I'll fill it back up over time, over the next 4 years or whatever. But heck, I'd rather take a $20,000 policy loan than pay $40,000 a year for college. So I'm very happy in that scenario. But for her, and this is why I'm jealous, when I think the numbers are, Nolan, when she turns, you know, 30 years old, and I feel like she's got her feet on the ground and she's making money and she can afford this policy, that $3,000 a year is going to lower, because in the juvenile policies, you can run that rider for about 15, 20 years.
Oh yeah.
And so when she turns 30, I'll turn that rider off and I'll give her that policy. I can gift her that policy, no taxable event, gift her that policy. And now the premiums are $1,200 a year, $100 a month. And I looked at it, and when she's putting in $1,200, it's turning into like $4,000 or $5,000 a year for her.
Wow. And
when she's 65, I think the total contributions of the policy are like $110,000, and there's like $600,000 or $700,000 or $800,000 of cash value in there. It's ridiculous, you know.
Wow.
I mean, so very small, you know, obligation for me and my wife to fund that thing. We could have done a 529 plan. We could have done other things, but those come with obligations and restrictions to that money and how I use it. I have total control of this capital. I was able to reward her for her hard work and give her that. And so, yeah, I mean, and then my youngest, who knows what'll happen with her? You know, she's a good athlete too, but she's pretty smart. So she'll probably get an academic deal, but she got it from her mom. Yeah.
To follow up, and if there's somebody on there that's got a thought or a question, obviously interject. I wanted to mention, I have a couple clients that are a doctor and a wife, and I wanted to tell this story because Mike had a really great insight on this that I really didn't think about. I think I knew it was probably in the back of my head somewhere, but I didn't think of it. Thankfully, Mike brought it up. But basically, they've got this doctor and his wife. They're starting 2 policies, both on each other, and they want to figure out they're high income earning doctors, but they want to figure out how they can lower their taxable income. Well, Mike was like, "Hey, dude, you need to show them that the IRS actually says," they got 4 kids, remember, the IRS says that you can actually pay your children $12,500 a year, and it's not only a tax deduction, but the money is tax free to your children. And so most parents would say, "Oh, just put this in a 529 plan," or whatever the Uncle Sam's asking you to do. But we're showing them, hey, funnel like $1,000 a month for each kid into one of these things. So you got a tax deduction in your business. You've got tax-free money essentially going in, and then you've got tax-free growth on the back end that you have access to the entire time. So it's like kill 3 birds with 1 stone. And so we showed the doctor and the missus this illustrations. I was like, dude, makes a lot of sense. You guys are basically saving money in taxes on your business. You're keeping more of that capital. Plus, you're giving your kids a really cool runway as time goes on. Again, they're like 11 and 12 years old, and maybe a little bit in between. But that's just something out there for whether it's for you, whether it's maybe somebody that start paying your kids. Like, start paying your kids. Like, Michael's like, oh yeah, your son, he's photogenic. Okay, pay him. I was like, can I really pay a 9-month-old? He's like, pay him. So it's like, okay, I'm going to start paying my kid. It sounds funny, but if you're out there, like, pay your kids. I mean, I didn't know that about that, but Mike was like, look, here's how you do it. He gave me the kind of the steps on it. And now this wife and this husband are like genuinely thrilled because they're saving more money in taxes. Their kids have a chance to kind of get some cool little growth thing. They get to teach them how to become infinite bankers. It just ends up being this really cool way of keeping everything in-house versus sending it to somebody else and letting them control it and not having access to it. It kind of convolutes everything. So I thought that was a pretty cool little story about that family, at least.
That's right. You got to have a good CPA. That's our disclosure. We're not CPAs.
Yep.
But
yeah, seriously.
Talk to your CPA and know the rules, but they're out there. The tax rules give you some great opportunities to take advantage of, and that's one of them.
And of course, guys, this is kind of what makes it cool is we've got an amazing guy on our team in Birmingham who's an amazing accountant. So if and whenever you need somebody, you can let us know and we'll shoot you his information. I'll send a connecting email, however Mike and I can help you, we'll do it. So as we're wrapping up, does anybody have a few more questions or thoughts? I know we normally like to leave the last 15, 20 minutes I say it like we do it all the time. This is our second one, but does anybody have any kind of thoughts, questions, kind of as we get ready to get out of here? Cool. All right. Well, Mike, man, appreciate your time, dude. Seriously.
Thanks for
Thank you,
having me,
man. It was awesome. Seriously. Again, guys, Mike is Keith. I will get you my guys' information. I'll actually text it to you. I've got your cell. So, Mike, again, dude, thank you, man. Seriously. Mike is a great guy. He's the one that got me into this business. He stuck with me, and I can't thank him enough because I was a arrogant kid that didn't know any better. Well, I thought I knew everything, but he stuck with me. And it's been one of the greatest things that's ever happened to me without being all wishy-washy or whatever. But well, guys, thanks for coming on tonight. We appreciate it. What I'm going to do again is I'll post this thing in our mastermind group. I'll post it on YouTube in our private group that you guys have access to, and then I'll put it on Spotify for you guys to listen that are audio people. So again, guys, thanks so much for your time. Mike, again, thank you, brother. We'll be in touch soon. All right, guys. Thank you, everyone. Talk soon.
Thanks,
See you next month.
Appreciate it.
Yeah, man.
Thanks,
See you,
Grant.
Grant. Thanks, everybody.
Yeah.
Yeah, we'll see you next week or next month. See ya.
You got it.